The tension is actually in the Middle East. A lot of traffic, especially about 35-40% of crude oil which moves through the sea, that is through the Hormuz Straits. That's closed now because that's one of the theaters of conflict. Central government plus state governments put together, the gross borrowing comes to around 27 lakh crores approximately. So it's a huge amount. Most of these stocks have been beaten down or have fallen to the extent of about 35 to 40%. 50% have lost altitude to the tune of about anything from 20 to 40%. So it's quite a drastic fall. It is possible to get good bonds, good quality bonds, which have a yield of around maybe 8.5, 8.75 to 9.5%. That could also be looked at. Once in every 2 years, there have been a fall in small caps and also mid caps. Bounce back has always happened within a span of
Hello, I'm Tanpreet, and in the world where headlines move faster than fundamentals, this conversation is where we pause to separate noise from narrative and narrative from numbers. Recently, it has been a difficult phase for India and global markets. Inflation seems to be under control for now. Rate cuts are anticipated, yet timing remains debated. Mid and small caps have corrected sharply. Technology is navigating the AI transition. Fixed income is back in conversation, and global allocations are becoming a serious part of Indian portfolios. Every quarter, we sit down with a man who anchors our research thinking, Dr. Joseph Thomas, Head of Research and Advisory at Emkay Wealth, to decode what is really driving markets, capital flows, investor behavior, and of course, what is shaping the wealth perspective. Dr. Joseph, it's always a pleasure to have you with us.
Thanks, Tanpreet. Nice to be here.
So, Dr. Joseph, last 1 week has been quite volatile amidst geopolitical tensions. What is the impact on Indian markets?
The geopolitical tension and developments will impact the Indian economy through mainly through two things. The first thing is the crude prices, the Brent prices in the overseas markets, which has already moved up to around $82 per barrel at this point of time, because the tension is actually in the Middle East and the Hormuz Straits is closed for any traffic, and a lot of traffic, especially about 35-40% of crude oil which moves through the sea, that is through the Hormuz Straits. That's closed now because that's one of the theaters of conflict. So if crude prices go up, domestic oil prices will also move up. That could induce some amount of inflation. The second factor is that our crude imports bill will go up, because crude prices have gone up, say from 65 to 70 range to now $82 per barrel. Second factor is that the dollar-rupee exchange rate today is at 92 rupees per dollar. The dollar-rupee exchange rate will be under some pressure for some time because of these geopolitical developments, because we do not know how well our exports would do. Therefore, through dollar-rupee exchange rate and through crude prices, there will be some adverse impact on the domestic economy. But it also depends on how prolonged this conflict would be. It's generally believed that this conflict may not last too long. It could be maybe for another 1 week or two. Things should get settled. That's what most of the analysts and political observers feel. If it gets prolonged, then it will have an impact on India's current account deficit through higher crude prices and higher dollar-rupee exchange rate and current account deficit. And also it will have some impact on the GDP growth as well.
Over the last year, we have seen inflation cool off. But there is still nervousness around, food and energy prices. When you look at India today, do you feel we are structurally more stable or just temporarily comfortable?
Inflation has been under control last 1.5 almost last 1 year, inflation is under control. In fact, inflation dipped to 0.75. CPI reading was 0.75 and now it has moved up to 2.75. So inflation reading has moved up, but inflation is under control. But RBI's assessment is that inflation could be higher as we move into the first quarter and second quarter of the next financial year. Inflation could move up towards 3.5%, which means that the projections for inflation is that it will be slightly higher from here. There are two factors, as I mentioned earlier, which would also put some pressure on the price level. The first one is that the Brent prices, crude prices, have moved up in response to the geopolitical tension and the war that's going on in the Middle East. And second is because of rupee cheapening up in the dollar-rupee exchange rate.
So, Dr. Joseph, we have also, seen the consumer price index move to a new base here. Could you explain the positive outcome of this shift?
Yeah, the new consumer price index, which has the base year as 2024, conforms to international standards. For the first time, the index conforms to international standards, which means that it can be used by international agencies for comparing inflation parity between India and the other countries. As per the United Nations Statistical Department, this conforms completely to the international standards. Second important thing about the CPI is that the composition or share of food items was about 46%, 46%. It has been now brought down to around 36%. A third factor is that the coverage of cities and towns and products has been changed. The coverage of items or products or services is enhanced to 58. So the total coverage at this point of time is around 358. And this 358, out of that 58 is new items which have been included in the consumer price index. Out of these 48 are goods and 10 are services. The index looks quite modern in the sense that we have included all these OTT subscriptions, rural housing rent, then other services like online media, airfares, online subscriptions, all these things, airfares, all these have been brought in as a part of the consumer price index. So it's a more modern or current index. So that's very useful for us. The best thing is that it is internationally comparable. And we had seen the inflation at 2.73 for January. We might see slightly higher inflation in the coming months, mainly because of the impact of this war on Brent and also on account of the weaker rupee.
So what do you think are the major factors likely to affect the trajectory of interest rates in the coming year?
Yeah, for the coming year, the interest rate outlook or the trajectory of interest rates will be governed by mainly two factors. If you keep the potential for inflation, higher crude oil prices and all that, that's a very important factor. If you keep that aside, assuming that things would normalize and stabilize over the next couple of months, the two important factors that would decide the trajectory of interest rates are, one, the government borrowing program, and second one is the liquidity management by the Reserve Bank of India. The government borrowing program, as you may be aware, is one of the largest government borrowing programs so far in this decade. It's a very large borrowing. Central government plus state governments put together, the gross borrowing comes to around 27 lakh crores approximately. So it's a huge amount, and there is going to be a very large amount which is going to hit the markets week after week from 1st of April onwards. But we need to wait for the borrowing calendar, which will be announced by RBI towards the end of March, to see in what phases, in how many phases and what pace it's going to hit the markets. But it will definitely put some pressure on the fixed income markets and also interest rates. That's the government borrowing program. That is very critical as far as the direction of interest rates is concerned. Second factor is that RBI has been managing liquidity extremely well. They have been very good as far as the liquidity management is concerned, and we expect RBI to continue with the same level of orientation as far as liquidity management is concerned. Because when you have 2 lakh crores of government borrowings to be organized month after month, it means that 2 lakh crores is taken out of the system into the coffers of the government, of the RBI. So therefore, so much of liquidity needs to be added to the system unless there are other inflows which would help the system or the interbank market to stay at the equilibrium level. So government borrowing program, it's likely impact. And second, the liquidity managed from the RBI are the 2 critical factors that are going to be of import as far as trajectory of interest rates is concerned. Beyond this, inflation, as we have just mentioned, inflation will be slightly higher. And in the overseas markets, also in the overseas countries, including the US, it is a kind of what do you call a neutral stance now from the Federal Reserve Bank of New York itself. So depending upon the data and all that, we do not know what kind of data are going to emerge now with this war and tariff issues and the confusions created by that and all that. So policy would depend to a large extent on data. As far as India is concerned, there is no reason why rates should go down from the current levels, nor is there any reason why rates should move up. But the pressure on interest rates on account of the government borrowing program will be there in the system, and that's one of the things we need to take cognizance of. And therefore, we need to modify our approach to long-term investing in fixed income.
Yeah. So I was just going to ask you that, what are the preferences in fixed income investment at this juncture?
At least for the last 6 months or almost 6 months to 1 year, we have been suggesting to investors to look at, from the mutual fund space, 2 sets of funds. The first is the medium-term funds. The second group is the credit risk funds. As far as medium-term funds go, they have a portfolio yield which is upwards of 8% and good quality portfolios. And as far as credit risk funds are concerned, they also have a portfolio yield which is upwards of 8%. And as far as the maturity profile is concerned, both medium-term funds and the credit risk funds, they have a modified duration close to around 3 years or so. So it's a duration which is acceptable against any kind of price risk. Portfolio quality is good. So these are the 2 avenues where investors could park their funds, apart from bonds, direct bonds, investments, especially of bonds which are carrying higher coupons. It is possible to get good bonds, good quality bonds, which have a yield of around maybe 8.5%, 8.75 to 9.5%. That could also be looked at. As far as long-term investment is concerned, what the investors should focus on is that we could look at performing credit funds. There are very good performing credit funds which have been launched by some of the major mutual funds who would be financing companies on a fairly medium to longer term basis. But one needs to stay invested for at least 3 to 4 years to maybe around 6 or even 7 years. Those are good products which investors could look at for longer term investments. And they would also offer you maybe 200 to 300 basis points higher net returns, most likely, from what some of these funds are offering at this point of time. These are the investment preferences at this juncture.
Dr. Joseph, coming to mutual fund regulations, there have been some important tweaks in the mutual fund guidelines recently. From the investor perspective, What do you think is the impact on these modifications? Do you think tighter norms could quietly change the way these portfolios are constructed going forward?
Yes. The norms which the SEBI announced are really very good. But I would like to highlight two things from all the norms which they have announced. One is that in thematic and sectoral funds, when they launch the new funds or even existing funds, the overlap should not be more than 50%. Overlap means the common stocks in different schemes or funds should not be more than 50%. At Emkay Wealth, whenever we suggest or recommend or design portfolios for investors, we do look at this overlap factor when we recommend mutual fund schemes, whether there is any kind of overlap, and we do not like it if the overlap is more than 40%. But SEBI has been slightly more liberal, putting it at 50%. So SEBI has put it on a more scientific basis to avoid overlaps. A lot of our investors at Emkay Wealth also have direct equity portfolios, and some of the direct equity portfolios have quite a large number of large cap stocks. Therefore, the overlap with large cap funds would be very high, could be even 60-65%. So we have been factoring in this when we were designing portfolios and recommending funds. But now that SEBI has come out with this, especially with respect to sectoral and thematic funds, the overlap should not exceed 50%. It's a very good thing which SEBI has done. That's the first thing, reducing the overlap. It is also known as closet indexing in mutual fund parlance. A second thing is that they have introduced what's called life cycle funds. They have decided to close down these solution-oriented funds like retirement funds, children's benefit funds, and all that. So they have introduced the life cycle funds, which may have maturities from maybe 5 years to even 30 years. So there are funds which will have maturity profile of 5 years. Some will have maturity profile of 10 years, 15 years, 20 years, up to 30 years. So these funds will serve the purpose of goal planning and also investment planning. Some of these funds may be capable of even helping investors as far as lifestyle planning is concerned, post-retirement. How do I maintain the lifestyle? And the SEBI circular also mentions about the glide path which needs to be formulated. Because if a person is investing for 30 years and his retirement also needs to be taken care of. So when he's approaching retirement, the portfolio progressively needs to come out of high risk or even equity investments and then move gradually into maybe fixed income investments. So that glide path also, SEBI has given it very clearly that the glide path also should be followed by these life cycle funds. So these are the two good things that have come out of that. Second is that the closet indexing, that is the overlap of 50% that has been now, that will be out of the system now. Second is the potential for life cycle planning through mutual funds, maybe for a period of 5 to 30 years, is the second thing that has, good thing that has come out of the SEBI. These are the two relevant things. There are many other things which are relevant, maybe from a mutual funds perspective.
So this is quite interesting. So the overlap process you've mentioned, is it a part of your ENF model, which is called the enhanced efficiency model? I mean, do you want to touch
No, it doesn't come into the model as such. It's a very important question that you have put to me. It doesn't come into the model as such while ranking the schemes, but while recommending, say, when we design portfolios and we recommend funds, and we have to recommend 2 funds, then we would see the level of overlap in the 2 funds and decide about which fund to be recommended.
Okay.
We can easily access the systems, even for even for portfolio management schemes, AIFs. We can easily work out the overlap and find out. So that comes at a second level. because NF serves as a ranking model, and it doesn't take cognizance of the overlaps as such. It takes cognizance of risk-adjusted performance and the ranking. The criteria of overlaps comes at a second level when we actually encounter designing for investor portfolios. It's at a second level. We do look at it on a continuous basis when we design portfolios. We avoid the overlaps. I mentioned to you about some investors or clients having large cap portfolios in direct equities.
Yeah.
So there is no point in offering them yet another large cap fund, but maybe offered maybe mid caps and small caps to some extent.
So talking about mid caps and small caps, they have seen an incredible run until September 2024, and then a sharp correction, followed in 2025, and even continues to date. When do you expect a bounce back in these two segments?
Yeah, let me first concentrate on the bounce back. Once in every 2 years, if you look at the last 10 years or 15 years, once in every 2 years, there have been a fall in small caps and also mid caps. It was more pronounced in small caps. And the fall has been anything from 20% to 30 or even 40% in some cases. So there has been a fall. It's something that we should always expect because the level of volatility in small caps, micro caps is very high. That's quite natural, and which is why they would offer maybe 200 basis points or 300 basis points higher returns to the investors. The bounce back after a 1 year or 2 year fall in small caps and mid caps, the bounce back has always happened within a span of 12 months to 18 months, which means that if we have seen a fall of maybe 25, 30 or 35% over a period of 1.5 years now, which we have seen so far, the bounce back will come after maybe another 12 months or so, 12 months or 18 months. And during the course of those 12 and 18 months that we are going to see forward, the prices will gradually move up. So bounce back is a matter of 12 to 18 months. The fall has been a matter of now almost 2 years now, about 18 months to 24 months since 2024. So bounce back will happen. Actually, now the bounce back, will it start happening today? Yes, it can happen from today because most of these stocks have been beaten down or have fallen to the extent of about 35 to 40%. Almost 50% of the stocks, if you look at the small cap universe, almost 50% of the stocks have lost value or altitude. So 50% have lost altitude to the tune of about anything from 20 to 40%. So it's quite a drastic fall. Now, it is time for us to look at good stocks and move into good mid-caps and small-cap stocks, or good mid-cap and small-cap funds, or well-managed portfolio management schemes, because they offer much better value as of today. Say, for example, what it was maybe 6 months back or 1 year back, in terms of the valuation, if you are looking at the PE, it's around, if you're looking at the trailing PE, it's around 29.30. And if you're looking at the forward PE for 12 months, it would be around 23, 24-ish. So the valuations look much better today, though we can't say that they are very cheap and all that, but they look more reasonable today. And this would be a time to start investing or taking small cap and mid cap funds into the portfolio. There are other factors which are supporting small caps and mid caps. We have been having relatively lower interest rates, and we have a lot of liquidity in the interbank market. Banks have plenty of liquidity with them. We have relatively lower interest rates. These are factors which are more relevant to mid caps and small caps and much less for large caps. So it's a supportive factor. Second factor is that the consumption spends, or even consumption spends are higher. and it will be further scaffolded by the tax concessions given to consumers. Last year, in the initial part of the year, we had the income tax concessions given to smaller taxpayers to a wider base. The second factor was the GST reduction. So these two have gone a long way in promoting consumption. That will help mid caps and small caps to a large extent. You also have yet another factor, which is the public capital expenditure of the government of India, as per the latest budget, which is for the coming financial year. It's around 12 lakh crores is going to be the public capital expenditure of the government of India. This public capital expenditure will go to various companies and firms, including defense-related purchases, railways, and it will also give a positive push to a lot of companies which may be very smaller, mid-sized companies and smaller companies, because if an order is placed with an L&T or a Bharat Forge or a Siemens or a Hindustan Aeronautics Limited, it benefits not only those companies, it also helps a lot of downstream companies who engage in manufacturing of parts, components, etc. So overall scenario for investing into mid caps and small caps is much better in terms of valuations, in terms of the overall environment, in terms of their potential to perform. Because if you are looking at the recent earnings announcements and earnings reports and all that, the potential for better performance from these businesses is much higher relatively compared to what it was maybe 2-3 quarters back. These are factors which support mid caps and small caps.
That's quite interesting.
Yeah.
So, Dr. Joseph, let's talk about technology. That has been corrected globally, and AI remains a big story. From an Indian IT perspective, does AI threaten margin gains before it enhances growth?
Now, as far as domestic IT sector is concerned, it's first of all, we should have one thing in mind. It is a sector which has outlived many major challenges, from Y2K to the Great Recession, then to the pandemic. It has outlived all these major threats to the IT industry, and it has grown really very big. Even in terms of its global reach, some of them would become, those are very large companies, and so that's the first factor. So they have weathered many storm, and their level of preparedness to meet any exigency is very high in terms of how they manage their finances, how they manage their workforce. Their level of preparedness is very high compared to any other sector or industry. That's the first part of it. Number two, so if there is a difficult situation, we should understand it from the historical perspective. They have withstood many a test, and they are well prepared. Number two, we have seen the rupee depreciating. The rupee has been weaker against the US dollar. So the rupee depreciation or a weaker rupee would always support better performance for the IT companies, because their business, a majority of their business is done overseas, and so they have receivables. And if they have huge receivables, to the extent they do not go in for hedging of their receivables, they make good gains in the dollar-rupee exchange rate. So that's also a positive factor. The third factor is that are our companies AI prepared, and have they been thinking about it? Yes, the larger companies, you take the names of any of the larger companies which are very well established. If you take the names of TCS or even an Infosys and all that, they give their guidance based on very objective factors. And after pricing in a lot of factors, including AI, and some of the bigger companies like the ones I have mentioned just now, they are already working with AI, with their clients, and manufacturing products and services for them. So they are already into it. Finally, something that we need to keep in mind is that AI should not be looked as a threat always. because human beings invented fire, human beings invented computers, human beings invented nuclear power, electricity. So it was possible for people to think about the negative aspects of this. But we never thought about those negative aspects all the time, but we thought about it as to how they could be put in a positive way. So I think AI should be looked at as a great opportunity, probably to get output on potential scenarios so that we could exercise our judgment and go in for the much better scenario which is suitable for us. So it can help us with research on alternate scenarios and all that, but ultimate judgment and the financial judgment would still continue with human beings. So it's going to bring about very relevant qualitative changes, and our companies, tech companies, are prepared to encounter that opportunity. Finally, the tech stocks have been sold off and they have become quite cheap. If you look at the large cap tech companies, the PE was around 35 to 40 or 45, and it has come down now below 20. Let's put it at 20, 25. So they have cheapened up quite substantially. The same is the case with even middle order and smaller IT companies. Many of them have cheapened up. Probably this is an opportunity there are people who are wary of investing into technology, but we believe that even if you would call it a contra call, it's a time to look at technology and look at the sector and move into very good funds, which would give you a very good exposure to technology. That this would be some kind of a tactical call which one could look at. The very good funds one could be investing into. That's our call on technology and the opportunity that's coming out of technology sector.
Okay, sure. So we're talking of investing. When we talk to investors, they have certain interest towards global exposure. They want to invest into, some stocks in global markets. So if you had to guide someone allocating fresh money overseas, where would you lean?
Yeah. There is a constituency of investors who would always want to invest overseas too, and it's a very genuine need which people have. Now, when we look at overseas markets also, two things we need to keep in mind. One is that there is a price risk. The US indexes have moved up very, very high, especially NASDAQ and tech index. And that's one of the things that we need to keep in mind. Second is that we have this geopolitical situation and all that, which would also put pressure on the markets, and it will put more pressure on developed markets like the US or in some of the European markets than Indian markets. So that's a second factor. Third is that given these factors still, which are those areas or territories which are making better sense for overseas investments? One territory or one area which makes immense sense is the emerging markets. Emerging markets, if you look at the emerging market index or emerging market portfolios, India, Japan, the returns which those portfolios of monies invested in emerging markets, the returns have been in the range of 30 to 35%. It's not a bad return, it's a very good return. It is highly likely that those portfolios and investments into emerging markets could retain their attractiveness for more times to come. A second positive factor which could support emerging market investments is that the FIIs are yet to come into emerging markets in a major way. Only with further rate cuts in the US, there will be money flows into emerging markets in a larger fashion, which at that point of time, India would also get more money. So once the US flows from the US would start happening, that would also help emerging markets to do better. And so emerging market funds, there are very good funds which are managed by experienced fund managers one could be investing into, and it is something that should be put as a part of the portfolio. A second territory which looks quite cheaper to buy is Europe. Europe, especially European financials and all, have been beaten down for the last few years, and they have not been able to rise as much as they wanted. So there is one critical thing which happened about 6 months back. The European nations and also the NATO guys, the EU guys had a summit in Munich, which was mainly focusing on their defense spending, and they have decided that they will enhance their spending from 3% of GDP to around 6.5% of GDP, which means that defense spends itself is going to go up. That will be beneficial to GDP growth, and therefore it's good for the markets and the economy in Europe. So Europe is another territory which is looking cheaper to buy, and at the same time which has very good prospects to perform. So one could be looking at global funds which have a greater orientation to Europe and European investments. These are the two things that one could be looking at. One is emerging market funds, and second is global diversified funds with greater accent on Europe.
So there's a very interesting article in Navigator on gold and silver ratio. Would you like to touch base on that as well?
That's a secondary factor. That's a secondary factor because it's actually the price movements which would determine that ratio. If you're looking at that ratio, then there is reason for some amount of restraint. But I think you need not be too much preoccupied with some of the secondary ratios while looking at the fundamental potential for the metal prices to go up, which we have based on two fundamental factors, which are mostly US-centric and central bank-centric.
So, Dr. Joseph, you have been suggesting gold and silver since last year, and it's mentioned in our Navigator. What's your take on the metals?
Yeah. Navigator, in the Navigator, we had recommended silver for the last 1 year or so, since the time the price was around $27, $28. And as far as gold goes, we started covering it from around 3,600, 3,800. Last 2 years, we have been recommending investments in gold. It has worked quite well for our investors, those who have invested into these metals. It's done very well. This performance is basically due to one major factor or two major factors. The first factor is that US interest rates have been coming down. Whenever US interest rates come down, the prices of these metals, especially gold and silver, they tend to go up. The second factor is that whenever US interest rates go down, the US dollar as a currency becomes weaker and weaker. If you look at the dollar index, it evidences that US dollar has been weakening. So lower US interest rates and a weakening US dollar are the two factors which support higher metal prices. So these two factors have been there, and the metal prices have moved up. Now, recently what has given it a little more strength is that the geopolitical situation, the theaters of war in the Middle East and also in Eastern Europe, that has also led to some higher demand for these metals. As far as silver is concerned, the commercial demand for it, industrial use and commercial demand for it also has been growing. But if you would have noticed it, as far as the silver is concerned, it has been very volatile, silver prices. The price moved up to around $120, and then the last fall was to around $75, and today morning it looks like it's at around $80. So it's highly volatile. So in volatile situations, one should be looking at very specific levels to invest into. Say, for example, in silver, $62 is a level where it could, even if it falls, it could stop somewhere around $62. As far as gold is concerned, because silver is about 9 to 10 times more volatile than gold, and gold is more orderly as far as price movements are concerned. And gold investments you can make at even the current levels or even a little lower from the current levels. We have seen some correction in the last few days. But as far as silver is concerned, you need to be more careful and cautious. I wouldn't suggest anyone to initiate a fresh position today. Unless it falls by maybe another 10 or 15%, it should not be resorted to. But gold may be invested into maybe at this current juncture also. So what is giving gold and silver the strength is mainly because silver has industrial use. Gold is demanded by institutional investors across the world, especially central banks. It may be because many central banks are expecting a weak US dollar. So when they expect a weak US dollar, the natural decision would be to exit US dollar because it's a depreciating currency, and then move into something that would appreciate in value, it's gold. And gold serves as a good reserve. It's equivalent to a reserve currency, so it can be used as a reserve. So a lot of central banks have been buying gold. These are the factors which helped gold and silver prices to go up. So there has been very, very, very strong investment demand rather than speculative demand. Quite often what happens is that in a scenario of rise in prices of gold and silver, quite often maybe about 50% of the movement upwards or downwards has been mainly due to speculative demand. So this time around, the speculative demand is very small component of the total demand and the price movement. That is what gives this upside greater strength to endure over time. Second is that if you look at the cyclical movements in the prices of gold and silver, usually a time of absolutely not much of movement in prices, but stable within ranges, or even a small fall that goes on for about maybe 5, 6 years or 7 years. That's a time when the prices, there won't be much of a change in the prices. If you look at the last 20 years, 30 years or 40 years data, you can see that. And after 6, 7, 8 years starts the upside. In both gold and silver, the upside in prices would start happening after 6 or 7 years of a trough plus slow movements in prices. Then we move into a phase of higher prices. Usually this boom period also continues for about 4, 5, 6 years. So we are into 2.5 years into the boom period, both for gold and silver. From this, we could infer that probably this upward movement could endure for maybe another 1.5 to 2 years or even 2.5 years, because this time around the movement has been very intense within a short span of time. So we could infer that maybe it will endure for another 1.5 to 2 years. So the boom is yet to reach its fruition. So it may take a little more time. So people can stay invested, and gold is always worth investing into. And but fundamentally, what gives it strength is a cut in US interest rates or a fall in US interest rates, a weakness in the US dollar as a currency against currency majors, which is visible in the dollar index. And finally, it is the geopolitical situation and uncertainties and people wanting to invest into that. Then comes central bank demand and commercial demand. These are the different factors which will determine this. That's our view on gold and silver.
But it's good to know that, we can still become a part of this growth journey, or, we still have some time to invest in.
There is still time. If you're going by the charts, because technical analysis says that there are two fundamental assumptions of technical. One is that price formations have a pattern to it. Price formations have a pattern to it, number one. You can read into the patterns and then forecast prices. And all factors are priced in the price movements. Any price update at any point of time captures all the known factors. The second thing is history repeats itself. So if you look at the charts, it's that maybe we are into the boom for maybe 2 years. It has another 2 or 3 years to go. This is what the technicals say. And fundamentals are, as I had told you, the commercial demand for these metals and also central bank demand against a further weakening dollar. These are all fundamental factors which give a push to the prices of these. But at the same time, we need to be careful about volatility, especially in silver. Silver moves 9 times faster than gold, so we need to be very careful about that. There is already an analyst view that the gold or silver prices are inflated to the extent of about 15 to 20%. As on today, it is inflated to the tune of about 20%, which means that any fall in the prices to the tune of about maybe 15-20% would make it more investment worthy. This is just a viewpoint. That's our view.
Sure. So, Dr. Joseph, it was an interesting conversation on different topics. Thank you so much for your time.
Thank you very much, Tanpreet. Thank you. Thanks a lot.
Thank you. The Navigator isn't just an investor magazine. It's a comprehensive micro to macro investment compass. Each edition covers equity and fixed income outlook, global cues like Fed and RBI policy shifts, currency movements, gold and silver strategies, infrastructure themes, and sectoral opportunities. It also includes detailed minutes from our investment committee meetings, portfolio positioning ideas, and update across PMS and AIF strategies. For investors navigating volatile global conditions, tariffs, geopolitical shifts, rate cycles, Navigator brings structured insight and disciplined thinking in one place. It reflects how we are positioning portfolios, not just what we are observing. If you'd like to access the latest edition, simply visit mkwealth.com, go to the resources section and click on Navigator. You can view or download the current issue there. It's designed for serious investors who value clarity over clutter.